You know, every single trader remembers the exact moment they first opened up a financial chart. Picture it. It's midnight, you're staring at your glowing screen, and honestly, it just looks like absolute chaos. You've got red and green candles jumping up and down, sudden spikes, terrifying crashes, lines drawn literally everywhere. It feels like the market is speaking this incredibly complex language you were simply never taught. But I am here to tell you it doesn't have to be this way. Welcome to this explainer. My promise to you is that by the end of our time together, that chaos is going to transform into a perfectly readable map. We are going to decode the market's hidden matrix.
Okay, let's dive right into this. Because before we do anything else, we've got to challenge a massive beginner assumption. When you see those wild, sudden price spikes and crashes, it is so easy to just assume that the market is completely random, just unpredictable mathematical chaos. But here's the real truth. The market is not random at all.
Just think about this quote for a second. Every candle is human emotion. This is our core thesis for today. The market moves in patterns simply because human emotions repeat themselves. Every single tick up or down on that chart, those jagged price lines you see, they're actually the literal footprints of repeating human emotions. We're talking about fear, greed, patience, hope, and yeah, absolute panic. Once you wrap your head around this, the charts stop looking like random noise and start looking like highly predictable behavior patterns.
Which brings us to, honestly, a pretty empowering realization. If you've ever struggled with trading, whether you're trying to grow a tiny account from your bedroom, or you're learning crypto, or you're just trying to manage your own savings, you really need to hear this. In trading, many people lose money not because they lack intelligence, but because they lack structure. You're not losing because you aren't smart enough. You're losing because you're entering trades way too early, exiting way too late, and chasing the price instead of actually understanding it. Market structure is the ultimate antidote to all that confusion.
So, here is our roadmap for the explainer today. We're going to cover the hidden reality, floors and ceilings, the memory of the market, traps and illusions, the battle plan, and we'll wrap up with rules of survival. Let's get to it.
All right, Section 1, the hidden reality, understanding market structure.
Before you even think about slapping a technical indicator on your screen, you absolutely must identify who is actually in control of the battlefield. Think of the market like a giant ongoing tug-of-war between two teams, buyers, who we call bulls, and sellers, who we call bears. The price? That's just the scoreboard. Now, in an uptrend, the buyers are clearly in control. The market pushes upwards steadily, creating higher highs and higher lows. Every time it pulls back, the dip is smaller than the last. But flip that to a downtrend and the sellers take the wheel. Every single attempt to rise gets rejected fast, creating lower highs and lower lows. The market just falls under heavy pressure.
Moving right along to Section 2, floors and ceilings. Let's map out that battlefield.
So what happens when neither the buyers nor the sellers are really dominating? Well, the market just kind of goes sideways. And this is where market structure gives us our most important landmarks, support and resistance. Support acts like this invisible floor, where a falling price tends to pause or bounce back up, basically because buyers see a good deal and step in. Resistance, on the other hand, is an invisible ceiling. Rising price slows down or falls back because buyers start hesitating and sellers start taking their profits. And please, if you take nothing else away, remember this. Professionals draw these as zones, not thin, magical, exact mathematical lines. Price doesn't just stop at one perfect number. There's market noise and huge institutional orders at play. Always think in zones.
Okay, Section 3, the memory of the market. Time to look at the psychology of reversals.
Now, what's really interesting about this slide is the why. Why do these invisible floors and ceilings actually hold up? Because the market has a memory of past pain and past profit. Let's actually walk through the exact emotional roller coaster traders go on as price approaches one of these key zones. It kicks off with confusion, which slowly turns into hope. Then, as the price creeps closer to that make-or-break level, hope morphs into fear. Fear escalates into outright panic, and finally, boom, action. It is this intense, shifting conviction of literally millions of traders that ultimately forces a market reversal. Reversals don't just happen because a price is arbitrarily too high. They happen because human conviction changes.
And precisely because humans behave like this, we get one of the most incredibly powerful phenomena in all of trading, role reversal. Broken support becomes resistance, and broken resistance becomes support. Why on earth does that happen? Well, imagine you bought at support, thinking it's safe, but then the price plummets right through it. You are now trapped in a losing trade. When the price eventually crawls its way back up to that exact same level, what are you going to do? You're going to aggressively sell just to recover your money and break even. Your desperate selling literally turns that old floor into a brand new ceiling.
Which leads us nicely into Section 4, Traps and Illusions. Let's talk breakouts versus fakeouts. You've got to be super careful out there, because the battlefield is literally littered with traps set by big institutional players to trick beginners. You absolutely have to know the difference between a real breakout and a fakeout. A genuine breakout, it shows real market commitment. It smashes right through a zone with a strong momentum candle, huge volume, and it doesn't look back. But a fakeout breaks the level just briefly, leaves this huge long wick showing a massive rejection, and quickly collapses right back inside the zone. It is purely an illusion meant to trap you.
Let's peek behind the curtain for a second so I can give you some empowering insider knowledge on how this actually works. Big institutions need what we call liquidity, which really just means areas on the chart where tons of orders are sitting waiting to be filled, so they can enter their own massive trades. And where are those orders hiding? They're the stop losses piled up right below an obvious support or right above an obvious resistance line. Smart money purposefully pushes the price past those levels just to trigger your stop loss. They hunt your liquidity, gobble it up to fuel their own trades, and then sharply snap the price back in the other direction. That right there is the mechanics of a liquidity grab.
All right, moving to Section 5, the battle plan. Let's see how this builds into 3 simple trading setups. So we know the psychology now, and we know the traps, but how do we actually trade this stuff? We need a solid battle plan. There are 3 primary, highly structured ways you can trade these zones. Number 1 is the bounce trade, where you're trading the reversal right at the zone itself. Number 2 is the breakout trade, where you enter on that strong momentum we talked about. And number 3 is the retest trade. And listen really closely to this golden rule. For all 3 of these, you must always wait for confirmation. Never, ever jump in blindly just because a price touches a line on your screen. You have to wait and observe the reaction first.
Let's methodically break down that retest trade, because honestly, it's the absolute safest setup for beginners. Here's exactly how it works. Step 1, price breaks a key level. Step 2, and this is crucial, you do absolutely nothing. You just wait for the price to return and retest that broken level. Step 3, you watch to see if the price actually holds that level. And Step 4, when the price starts continuing in the original breakout direction, that is your confirmation to enter the trade. Why is this so powerful? Well, by waiting for that retest, you are effectively filtering out almost all of those deadly fakeouts we just learned about. Finally, Section 6, Rules of Survival. We need to talk about the professional mindset.
Look, having the absolute best chart setups in the world means literally nothing if you don't have the mental discipline to protect your capital. I want to rapid fire through these deadly beginner pitfalls so you don't fall into them. Drawing way too many lines, that just leads to total confusion. Remember, less is more. Entering without confirmation, that's how you get caught in traps. Moving your stop loss emotionally just because you're scared to take a tiny hit, that is exactly what leads to massive, account-destroying losses. Overtrading, that just leads to emotional exhaustion. And ignoring market structure entirely means you are literally just guessing. Without strict rules, patience, and risk management, even a great strategy will fail.
I want to actively challenge you for a second here. Look at the stark contrast between these 2 mentalities. A beginner predicts, guesses, reacts completely emotionally, and demands absolute certainty from a market that owes them nothing. But a professional simply sits back, observes, and reads the structure. They manage their risk with an iron fist. They wait patiently for the price to come to their zones. They think purely in probabilities, knowing that every single trade has a win or loss possibility. So, which one are you going to be?
I want to leave you with one final powerful thought that perfectly sums up everything we've uncovered in this explainer today. You do not need to predict the market to profit from it. You only need to understand where it is likely to react and wait. The chart is no longer just random noise to you. It's a living map of human behavior, just waiting for you to read it. So the next time you open up your screen, armed with this structure and this patience, what is your next chart going to reveal to you?